In a world of increasing economic uncertainty and volatile government credit, why does gold remain as the stabilizing force in the international monetary system even after the end of the gold standard era? How can gold hedge against both inflation and deflation? Today, I want to introduce you to the book, The New Case for Gold. The greatest value of this book is that it provides a new perspective for understanding the role of gold in today's international monetary system. Before we get started, please click the subscribe button to support the Daily Book Dive channel and stay updated. First and foremost, I need to remind you that studying the logical thinking in this book doesn't mean we have to accept its conclusions. On one hand, the book was published in 2016, and in recent years, with changes in the international situation and policy environment, the investment risks of various major assets, including gold, have increased, and their price trends are quite uncertain. On the other hand, the factors and causal chains affecting gold price movements are complex and intertwined, with multiple interpretations in the market. We need to view these voices rationally and make investment decisions cautiously. Now back to the book. We know that gold is one of the oldest metals discovered by humans, and the gold market has been a perennial topic. So why does this book re-examine and discuss this topic at the beginning of the 21st century? This needs to be explained from a peculiar phenomenon in the international monetary market. Historically, the global monetary system was based on the gold standard for a long time. Even after World War II, when the US dollar became the world currency and other national currencies were priced in dollars, the underlying cornerstone of this monetary system was still gold because the exchange rate between the dollar and gold was fixed. However, in 1971, US President Nixon announced that the dollar would no longer be convertible into gold. Almost all finance textbooks will tell you that this ended the long history of the gold standard, marking the beginning of the paper money era. At this point, it seemed that gold no longer had a place in the international monetary system and should not play any role. But if you look at gold reserve data, you'll find that even today, countries are still competing to buy and hoard gold. Even the International Monetary Fund, IMF, continues to hold massive gold reserves. What's going on here? The book tells us that this paradoxical phenomenon actually sends a crucial signal. The currency war is outdated, and the gold war is the future. This is the true meaning of the term new era in the book's title. The author, James Rickards, is a consultant, investment banker, and risk control expert with over 30 years in the capital market. He has advised the U.S. Department of Defense, intelligence agencies, and major hedge funds on global financial issues. He is a frequent guest on major financial channels and has published 2 best-selling books, Currency Wars and The Death of Money. Knowing the author's background, you will find some interesting things when you read this book. As a thorough American financial analyst, the author is not optimistic about the US dollar but fully affirms gold's monetary properties. More surprisingly, as someone who once wrote Currency Wars, why does the author now say, the currency war is outdated, and the gold war is the future? Overall, the author gives 2 reasons. First, gold is the real money. Second, gold is eternal insurance. Next, let's talk about the thinking behind these 2 reasons. Part 1. First, why does the author believe that only gold is real money? Note that this does not mean only gold is money. In fact, anything that can be used simultaneously for transactions, bookkeeping, and saving can be called money. Whether it's shells, copper coins, gold ingots, silver dollars in human monetary history, or the paper and electronic money we use now, or future central bank digital currencies, they all fall into the category of money. So why does the author think that only gold is the real money? The first reason is that gold is the most suitable substance for money in our known universe, without exception. This conclusion may seem arbitrary. There are countless substances in the universe, so why put the most label on gold? The reasoning is actually not complicated. Let's deduce it together. First, recall the periodic table of elements we used in middle school. You might remember it as a matrix composed of square grids containing 118 chemical elements. In the known universe, all substances are composed of one or more of these elements. So, to find a substance suitable for money, the most effective method is to look at these elements. The first to be ruled out are elements that are gases or liquids at room temperature, as well as toxic and radioactive elements. Among the remaining elements, those with poor stability are easily ruled out, such as magnesium, calcium, and sodium, which dissolve or explode upon contact with water, or iron, copper, and lead, which rust or corrode easily. Continuing further, aluminum is too soft and titanium is too hard and difficult to smelt, so they are not suitable either. After eliminating these candidates, only 8 precious metal elements remain on the periodic table. Besides gold and silver, there are 6 platinum group metals. How to choose among them? The author says that the precious metal suitable for money should be relatively rare. This has 2 meanings. First, it must be rare, otherwise its value is low, but it shouldn't be too rare because if there is too little of it, few people can possess it, making it impractical as a medium of exchange. For instance, the global annual output of platinum is only a few hundred tons even today, and other platinum group metals are even rarer. Thus, among the many chemical elements, only gold and silver meet both criteria. These 2 elements are also quite suitable as money because besides being relatively rare, they have relatively low melting points, making them easy to process into coins, ingots, and jewelry. This is also confirmed in reality. We know that gold and silver have been the most common materials for money throughout world history. The longest-lasting monetary system in history was the bimetallic standard, where gold and silver were both legal tender. However, from the perspective of material properties, gold is undoubtedly a more ideal choice for money than silver. First, the bright yellow color of gold is rare among metals, whereas silver's white color is common. Additionally, gold does not tarnish over time when exposed to air, while silver reacts with trace amounts of sulfur in the air, turning its surface gray-black. This is why scholars believe that gold is the best-suited material for money among all known substances in the universe. The author believes that the process of reaching this conclusion also reflects that our ancestors used gold to make the earliest legal tender, not just because it is shiny and attractive, but because gold uniquely possesses the ideal properties of rarity, non-oxidation, uniformity, malleability, and durability. Even in today's digital age, gold still has advantages as money that other substances cannot match. Now, national currencies mainly exist in the form of paper money and electronic money. The author points out that, at the atomic level, their stability is actually much poorer compared to gold. For instance, electronic money essentially consists of charged subatomic particles stored in silicon chips, which can be hacked or erased, whereas gold atoms are very stable and cannot be erased by malicious cyber attackers. So, the author's first reason for saying only gold is real money is that, in the known universe, gold is the best-suited material for money. The second reason focuses on the current international monetary system. The author believes that gold is the real base currency supporting the international monetary system. Note that the basic coordinate system for our discussion changes here. What does that mean? Earlier, we compared different materials used for money, assuming their nature as physical money. Physical money's value is based on the substance itself. But we know that the legal tender issued by central banks today, whether in paper or electronic form, is fiat money. So, gold and fiat money are fundamentally different, with one based on physical value and the other based on government credit. Please note this point as it is the foundation for our subsequent discussion. When we compare the value basis of gold and fiat money, we see a fundamental difference. Physical objects can be held firmly in hand, while credit is intangible. For physical money like gold, we can accurately divide and weigh it and understand its intrinsic value. However, paper or electronic money is essentially just a series of digits on an account, and we cannot always clearly perceive whether the credit these digits represent has increased or decreased. Moreover, if you lock away a gold bar, it remains the same bar years later. In contrast, if you lock away a stack of banknotes, even if they don't decay or mold, the meaning of the digits on the paper will undoubtedly change over time. Therefore, the author points out that gold, as a physical object, can provide a hedge against the risks faced by fiat money. This partly explains the paradox we mentioned earlier, why, in an international society that universally uses fiat money without a base currency, major countries still hoard gold, which seems useless. The author further suggests that this phenomenon reflects an overlooked truth. In a world where economic uncertainty is increasing and government credit is fluctuating, a shadow gold standard has already formed internationally. In other words, while there seems to be no base currency in the current international monetary system, in essence, gold is playing a similar role. The author also proposes a method to assess each country's shadow gold standard by examining the ratio of a country's gold holdings to its GDP. This ratio can be easily calculated using official figures. The author says that comparing these ratios for different countries reveals the gold power each country holds. As of the book's publication, the top 3 holders of international gold reserves were the United States, Germany, and the International Monetary Fund. I checked the latest data from April 2024, and the ranking remains the same. The U.S. holds 8,133 tons of gold, with gold accounting for 78.6% of its foreign reserves. Germany holds 3,362 tons, with gold making up 75.7% of its foreign reserves. The IMF holds 2,814 tons of gold, slightly less than Germany. You might notice an odd point. It's understandable that major countries hoard gold, but why does the IMF also hold so much gold? The author believes it's because gold is a hard currency, safer than the IMF's ultimate safety net, SDRs. SDRs, or special drawing rights, are not a right but a reserve currency that can be used like gold as a country's foreign exchange reserve. SDRs were introduced after the U.S. government announced the dollar's cessation of gold convertibility. At that time, the dollar could no longer serve as an international reserve currency, and other currencies were not qualified for this role. So, countries decided to establish a new monetary system with SDRs as the reserve currency, which is the current international monetary system. Since SDRs are a currency, how is their value determined? The method is called a currency basket. IMF member countries vote to select several representative international currencies to include in the basket, and the value of SDRs is the weighted average of the values of these currencies. If you're interested, you can find the specific calculation method online. What is the purpose of SDRs? Let's simulate. Suppose you are country A. As an IMF member, you now have 5 billion SDRs as reserve currency. When can you use them? There are several situations. If you owe country B but cannot repay, you can call the IMF to convert your SDRs into B's currency for repayment. Besides, you can use SDRs to pay loans and interest to the IMF directly or conduct financial transactions like lending and repaying loans with other member countries. This shows that SDR's primary function is to provide liquidity support to IMF member countries. The author suggests that when the next global liquidity crisis occurs, the Federal Reserve and other central banks will be unable to contain it, and the world will have to turn to the IMF. This is because further printing money by the Federal Reserve to inject liquidity into the market will only erode public confidence in the dollar, further reducing its credit value. The same logic applies to other central banks. Therefore, the world needs the IMF to inject liquidity by issuing SDRs. However, recall what we mentioned earlier about SDR's value calculation method. It is akin to a composite of several credit currencies, so essentially it is also a credit currency. Its intrinsic value is the weighted average of the credit values of several currencies. Hence, from a global perspective, issuing SDRs to inject liquidity is not fundamentally different from issuing dollars or other major currencies. The author argues that large-scale SDR issuance will also lead to high inflation, and people may lose faith in the IMF and SDR solutions. In other words, SDRs are the last liquidity guarantee of the world financial system. If a country's currency credit collapses, there are still IMF SDRs to back it up. But if things worsen and even the IMF's credit collapses, then gold, as a hard asset, will be the only safe haven. The IMF's power source is its gold holdings plus the gold stored by its member countries in the US and Europe. The IMF's significant gold reserves indicate that it is aware of this point. In summary, the author's reasoning is, in today's world, where economic uncertainty is rising and confidence in various credit currencies is lacking, countries are accelerating their gold purchases. This trend, along with the massive gold reserves held by the US, the Eurozone, and the IMF, indicates that a shadow gold standard has already formed internationally and is moving toward a more formal gold standard. This phenomenon shows that gold is the real base currency supporting the current international monetary system. Part 2. Now, let's discuss why the author believes gold is eternal insurance. This statement has two keywords: insurance and eternal. First, let's look at insurance. In this context, it means that gold is insurance against inflation and deflation. Gold can resist inflation, which is easy to understand. Generally, the best way to combat inflation is to convert cash into physical investments, such as real estate or precious metals like gold. However, investing in real estate requires large amounts of capital and has low liquidity. In contrast, investing in gold requires less money and is easier to liquidate. Thus, hedging against inflation is a primary reason many people invest in gold. Then, why is gold also insurance against deflation? Let's examine the logic behind this. Deflation means a sustained and widespread decline in prices. If gold can counter deflation, it implies that gold is an exception when other prices are falling. But this seems contradictory because we often see gold prices fall along with other prices during deflationary periods. For instance, around 2015, during the financial and geopolitical crises in Greece, Ukraine, and Syria, the US experienced deflation, and the dollar price of gold also fell, leaving many gold investors feeling disappointed. According to our previous reasoning, gold should be a safe haven asset during crises, so why didn't its price rise? However, if we compare the gold prices at 2 points, June 2014 and January 2016, the start and end of the crisis, we find that despite many fluctuations, the average gold price remained almost unchanged over this period. In contrast, oil prices dropped by 70%. Compared to many major commodities during the same period, gold's performance was relatively ideal. The reasoning is that during economic crises or severe deflation, although gold prices may fall, other commodities' nominal prices often fall even more. Therefore, in real terms, gold retains its value. This is especially true during severe deflation. Historical data shows that gold's dollar price usually performs well during deflationary periods. Why? The author argues that deflation helps alleviate the actual burden of sovereign debt, so the Federal Reserve generally prefers inflation and cannot tolerate deflation. Thus, they will use measures like quantitative easing or forward guidance to generate inflation. If these measures fail, they can artificially create inflation by setting a higher dollar price for gold. Why does raising gold prices generate inflation? The principle is that if the dollar price of gold increases, it means each dollar can purchase fewer goods. So, the prices of all other goods will quickly adjust upward, leading to widespread price increases, which defines inflation. This logic is not just the author's subjective assumption but has occurred multiple times in history. For instance, in 1933, during the Great Depression, the U.S. was experiencing deflation, and gold prices in dollars had fallen. The U.S. government then manually raised the gold price from about $21 per ounce to $35. Their aim wasn't just to raise gold prices, but to make prices of other commodities like cotton, oil, steel, and wheat rise as well. When these prices rose, inflation appeared, and the government achieved its goal of ending deflation. In summary, the author believes that at the current juncture, regardless of whether inflation or deflation prevails in the future, gold can maintain its value. Hence, gold is one of the best insurances. Finally, let's address why the author calls gold eternal insurance. Why add eternal before insurance? It's because gold's intrinsic value remains unchanged despite external price fluctuations. When we say gold's price rises or falls, it's not gold's value changing but the currency's price fluctuating. For example, when the U.S. government raised gold prices from about $21 to $35 per ounce in 1933, it seemed like gold prices rose, but in reality, the dollar's value decreased. Following this reasoning, in the dollar environment, gold can be considered a reverse currency. Rising gold prices mean a depreciating dollar, and weak gold prices indicate a strong dollar. Thus, the author believes that if people expect the dollar to depreciate gradually, they will consider adding gold as insurance to their investment portfolio. However, if you're investing in gold outside the U.S., the situation differs. Here, the international and domestic gold prices use different units, creating exchange rate risk, for example, the risk from changes in the local currency's exchange rate with the dollar. Specifically, if you earn in a local currency, while gold prices in dollars remain unchanged, the gold price will fall if the local currency appreciates against the dollar, and the gold price will rise if the local currency depreciates. For example, if gold prices in dollars drop by 10%, but the local currency's dollar price drops by 20%, gold prices in local currency will actually rise. So, how should we view this exchange rate risk? On one hand, looking at gold's price alone, you may bear losses or gains due to exchange rate changes. So, when investing in gold domestically, you need to analyze both gold's dollar price and the local currency dollar exchange rate. On the other hand, you don't need to be too worried because gold diversifies the exchange rate risk of holding a single currency asset. Why? The author argues that since gold is priced internationally in dollars, holding gold adds an international or dollar asset to your domestic portfolio. This is attractive for families wanting to hedge against local currency depreciation risks. Moreover, if you find it challenging to predict exchange rate changes, don't worry too much. For gold holders, the key concern isn't the nominal price of gold, but the weight of the physical gold you hold. Since gold's nominal price fluctuations are mainly due to currency price changes, and given the current volatility of currency prices, it's more effective to consider gold's role in your investment portfolio from a physical gold perspective. In conclusion, we've now covered the book's core issue: why the currency war is over, and the gold war is the future. The logic might be complex, so let's summarize briefly. The first main reason is that the author believes gold is the real money. First, gold is the best-suited material for money in the known universe. Second, amid increasing volatility in the value of various credit currencies, gold as a physical currency, has become the real base currency supporting the international monetary system. One significant indicator is the shadow gold standard that has already formed internationally. The second main reason is that gold is eternal insurance. First, gold can hedge against inflation and deflation. Further, because gold's intrinsic value is eternally stable, it has a lasting ability to hedge against currency price fluctuations. By following the author's reasoning, we understand why gold still acts as a stabilizing force in the international monetary system even after the end of the gold standard era. The fundamental reason for this stabilizing force is simple. In the current international monetary system composed of national credit currencies, inflation and deflation are essentially changes in a currency's domestic price, and exchange rate fluctuations are changes in its international price. Thus, the currency war is essentially a price war of national credit currencies. But as the book tells us, gold, as a physical currency, is not influenced by the value changes of credit currencies and stands apart from the entire credit currency price system. Therefore, in this battle, gold, as an outsider, becomes a stabilizing force. The author believes this is also the underlying logic for why many countries and individuals include gold in their investment portfolios, to add a final line of defense in an increasingly uncertain battlefield. That's the essence of this book. The original book link is attached at the end for further reading. You can also click the share button below the video to share this book with your friends. Congratulations, you've just finished another book.